So there's 42 companies and ETFs that we're going to talk about right now that you could potentially make literally millions of dollars on this stuff. And the last five, honestly, like I'm personally making plays on it. It's probably going to blow you away what we could actually do with those companies. Some plays will be bullish, some plays will be bearish. But by the end of this video, you're going to have a lot of things that you can make plays on right now and potentially make a lot of money. So it's going to be a lot that I'm going to jam pack in here super quick. But let's just start off on Triple Q, which is an ETF that tracks the NASDAQ. Everything's going to be a 5 year chart, by the way. So you can see that the NASDAQ went up roughly 108% in the last 5 years. A big move was made. A lot of people are saying the NASDAQ is a bubble and, AI is kind of priced into the stock market right now. I do kind of agree with that. And the play to make on Triple Q is probably just going to be to buy and hold for the long term. I do not think we're going to get a massive return on this in the near term. VOO is another similar thing. It tracks the S&P 500 and it did make a big move in the last couple years, up 92% in the last 5 years. Again, I do think the market's a little bit expensive. So this is something that if you want to buy it, I would buy it and hold it for the long term. And VOO and Triple Q are something that you could hold as your base portfolio. Pretty much just all the money you make with stocks and options, you just route that money to the base portfolio and you're going to be fine in the long term. As for SQQQ, which is the next one, you could see in the last 5 years, the stock pretty much went straight down, but that's because this is short Triple Q. So basically, whatever Triple Q does going up, this is going to do it triple leverage the other way. So if the NASDAQ happens to fall 1%, SQQQ is going to go up by 3%. So maybe you think that the market's hot and maybe you think it's going to take a little bit of a breather. You could potentially go buy some call options on SQQQ as a hedge on some downside. And personally, I am doing that a little bit right now too. VCLT is one that tracks the price of bonds. So if you think that bond yields are going to fall because we have a recession or the Fed just simply cuts, this is something that you could buy and potentially capture a little bit of appreciation because, again, as share price goes up, bond yields go down. That's kind of how bonds work. And you could capture like a 5% yield in the meantime doing that. Tesla coming in at number five, you can see in the last 5 years, it did a pretty big move, 217%. But geez, there's a lot of volatility on that one right there. The valuation on Tesla is pretty much all built on Optimus, on Robotaxi, and all these things in the future that are expected to come, but haven't really came yet. So that's why there's so much volatility because investors just simply don't know how to price this company. I do think that if humanoid robots and the robotaxi do actually materialize, you're going to wish that you bought it for 440 a share right now. If it doesn't materialize, the stock's probably going to fall a lot. AMD is another one that we got to talk about. And geez, look at this move that we took off of this April low right here where we had the tariff stuff with Trump up over 200%. Wow, big move on AMD. And in the last 5 years, it's up roughly 180%. So AMD is a company that competes with NVIDIA to design chips for AI data centers. I do think that AMD is going to be fine for the long term, but there is going to be a lot of volatility because NVIDIA is the top dog. AMD is actually a little bit more expensive fundamentally than NVIDIA right now also. So, be careful with that one. And this kind of just builds us right into NVIDIA actually, where you could see the stock in the last 5 years is up 1,300%, which is absolutely insane. But at the end of the day, stocks follow what the earnings and the profits of these companies do. Nvidia's earnings also went up at a similar rate as this. So if you think that AI is going to be the future and you think that we're still going to have this massive data center build out, I do think that Nvidia's, it's hard to bet against that company right now. Apple's a company that in the last 5 years that has been trending up and everybody talks crap about when are they ever going to innovate. They're innovating and the company is up 112% in the last 5 years, which is pretty dang good. Everybody is saying that the new iPhone that's coming out is going to have better than expected sales, and Apple is working on a new folding phone to compete with Samsung that will generate the next, upgrade cycle for them. So this is kind of like a blue chip company that's kind of steady eddy, not much, not extreme growth, but it is still growing pretty good. Consider that for your portfolio. But again, the valuation of Apple, it's no surprise that Warren Buffett's been selling a little bit because things are a little bit expensive for Apple. Microsoft is another company that, geez, it made a really big run in the last 5 years, basically going from 215 bucks a share all the way up here to 515, and it's up roughly 138%. This is a company that makes a lot of money from subscriptions, and I don't really have to explain to you what Microsoft does. But Microsoft, again, is a kind of similar company as Apple, where it's something that you could hold for the long term. But I don't expect a big move to come on this stock. I think that a lot of the things to come are already priced in. So it could indicate it is a little bit expensive in the short term. Now, Marvell is an interesting company, and they actually compete with NVIDIA and AMD on the other side of the equation because companies that don't want to go with NVIDIA and AMD, they just say, we're going to go build our own chips. And Marvell is basically a company that helps them design their own chips. And if that trend continues to happen, Marvell could get more business. But also, if NVIDIA and AMD just become so good and so much cheaper and efficient than what someone could design with Marvell, like that's downside risk for Marvell. So this is a company that I'm not really, I don't really know what to do with this company to be completely honest with you, but I just want to give you my thesis of what's going on. And honestly, this is one of the companies that I would not actually touch, but definitely something to keep your eye on in case Nvidia or AMD start to fall out. Now, Broadcom, geez, this is a big dog right here that basically does things that are similar to Marvell and helping companies design their own chips. But Broadcom did just recently acquire VMware, which is a company that is really big in AI and technology space. And this is really just driving so much revenue to the top line, and they're bringing that to the bottom line too as earnings per share. And again, that's just helping push the stock price higher and higher and higher. Fundamentally, though, I do think that Broadcom is a little bit expensive. So it does kind of fall into that category with Apple, Microsoft, and Marvell, and really even NVIDIA and AMD. They're all kind of on the expensive side. But again, if you think that those companies are going to be the future, they could be pretty strong holds. So there's not really any table pounders just yet for trades to make, but trust me, they're going to be coming towards the end of this list right here. Micron is definitely one to look at. And geez, like look at this bounce that Micron did off of this April low when we have tariffs. The stock is up over 207%. Wow. And this company works in the memory space in the AI sector, and you really can't get AI without Micron. Now, the issue with Micron is that the sector that they're in is so cyclical, meaning it goes through boom and bust cycles all the time. So if the AI sector does happen to slow down, Micron is probably going to take a hit. And after it just made this big move right here, I don't really think there's that much upside to be made. So if you hold shares, consider maybe buying puts or consider selling cover calls on those shares to capture a little bit of cash flow when you're doing this. But for Micron, I'm not really too bullish on that stock right now. Now, Google's been a company that, I've been talking bad about for a while now because I don't know if they have a durable competitive advantage. Like, I feel like their moat is potentially going to be eroded by things like ChatGPT and Grok and Perplexity and Claude or whatever things they're doing, these AI chatbots, because I'm doing less Google searches, and I'm sure that a lot of you guys are doing less Google searches also. And, here you can see the stock is up over 207%. But the point I'm getting at is, the stock was fundamentally pretty cheap on this April dip. And you can see that it bounced really hard off of that dip, kind of just catching up to where it should be with the fundamentals. So it's kind of like overblown on this dip, and then it's just reverting back to the mean line of earnings per share growth, which their earnings per share growth is good. I can't challenge them on that. But this is a company that I'm just not sure about because I'm not sure about their moat going forward and if they are going to get wiped out in some way by, these AI chatbots. I understand that Google's pretty good and they do have their own chatbot, but we'll see how the search volumes actually go in the long term. Palantir is a company that I've been pounding the table on saying that it is a bubble and the stock hasn't crashed just yet, but you could see the stock's up over 1700% in the last 5 years. I think the stock's super expensive. I think that trading for over 300 times earnings, I don't think it's sustainable to be trading at this high valuation level. And eventually this stock will come back to earth. JD is a company that's kind of like the Amazon of China, and you can see the stock is down quite a bit. If you had this company that was in the United States, the stock would be trading much, much higher because you're getting that United States premium. But because this company is in China and they have a lot of headwinds with their new delivery service that they're trying to implement, you can see that the stock is down roughly 68% in the last 5 years, and it sure doesn't help with the trade war stuff going on with China. Intel is a company that I don't feel like it's really anything to look at. There's no moat, there's no pricing power. Yes, we got some investment in them with the United States, but I don't think it's a big enough needle mover to invest. I don't think that they're going to be able to compete with Nvidia, with AMD, and with TSM. Hims is another company that's really been the hot stock, and you can see in the last 5 years, it's up roughly 255%, basically trying to do like the cool way to do healthcare and lose weight and stuff like that. Maybe it does good, maybe it does not, but I think that Amazon is definitely going to be a competitor with them. And I wonder like, does Hims really have a durable competitive advantage in the long term? I kind of doubt that. So I'm not really going to invest in this company. Fundamentally speaking, though, it's not really horrible. So if you do think that, this company is going to do well going forward, it's not a bad entry right now because you are on a little bit of a dip right here, but it's going to be bumpy going ahead. Now, IWM is a ticker that tracks the Russell 2000 small cap, and you can see in the last 5 years, it's up roughly 58%. And this is something that, Tom Lee, everyone knows Tom Lee. He's been pounding the table saying it's the summer of small caps and small caps are going to rally and go up a lot. But they've been underperforming by quite a bit in the last 5 years. And you could see again, 58% in 5 years is not amazing. And, the thing about it is roughly half of the Russell 2000 companies are not profitable. So when you calculate the fundamentals on it, many people say, oh, yeah, the fundamentals are cheap. But that's because the fundamentals are not factoring in the non profitable companies. So this is artificially cheap because of the way that they're calculating the data. So be very careful with that. But the Russell 2000 is something that probably will do well in the long term, and I would allocate to it right now, to be honest with you. Even after this big run that it just made off of the April 8th low, you could see we're up 40% in just a couple months. I do think there's still opportunity for upside here, and I would not be against allocating to it. Alibaba is another company that's very similar to JD, and it has the same risks, basically where it's in China, and if it was in the United States, it would trade at a much higher valuation level. But the fact that we're in a trade war with China, or whatever you want to call it, trade war, trade uncertainty, this stock is trading at a discount to what it should actually be trading at. And to be honest with you, it probably always will be. SoFi is a company that's been on the absolute tear lately, and I am kind of against SoFi because of the valuation level that it's trading at. And you can see the stock is really only up 11% in the last 5 years because obviously it had this big drawdown and then this big run back up. And yes, they're growing revenue good, they're growing earnings per share really good, but you're paying over 100 times earnings for a fintech bank. And I just don't think that when you could go buy a Chase Bank, for example, at 15 times earnings, I don't think that it's worth it to pay that much more for SoFi. I just can't justify that. Celsius is a company where it's kind of like the new hot thing with energy drinks and, healthy way to do it. Stock's up 761% in the last 5 years on an absolute tear. Big blow off top up here, though. Let's figure out how much that actually went down from peak to trough. Down almost 80%. Wow. And, this is a company that if you go to a grocery store or gas station and you feel like this is the only thing that you're ever going to buy and it's always going to be like that, kind of like a moat like Coca Cola might have, consider buying this stock. If you don't feel like that, I would not buy the stock because, there's so much competition out there. They have to be the best or it's not worth it to buy it. Number 22 is going to be Chase Bank. And honestly, like the stock is still fundamentally cheap. It's trading at roughly 15 times earnings and it's up 187% in the last 5 years. Banks are going to be fine for the long term hold, but they will have a lot of volatility. You could see when interest rates went up back here in 2022, the stock fell roughly 41%. And interest rates are expected to keep falling. So maybe this is going to be a tailwind for the company because there'll be more refinances. But also on the other side, it's going to be a headwind because there's going to be less net interest income. So if you want to buy the stock, I would just recommend to hold it for the long term. And I don't really have to elaborate on Bank of America because it's kind of the same exact thing. If you want to hold this stock for the long term, I think you'll do good. But again, it's not really a table pounder. It's up 106% in the last 5 years. Netflix is a company that, geez, it made a huge run and had a really big drop rate here. Let's just measure this drop and see how far it really went down in the last drop rate here. Wow, 75%. But, in the long term, it's up and to the right. And, there's a lot of streaming services out there, and I'm not sure how durable the moat is on Netflix. And after making this really big move right here, I would consider selling covered calls if you have some shares. I wouldn't necessarily want to go buy puts just yet because it's not that expensive, but it is on the high side. CSX is a company that's been around for a long time. It's a railroad company that, if you just want steady Eddie dividends and cash flow, this is something that you could consider to buy, but I wouldn't really expect much growth here. The stock is up roughly 38% in the last 5 years. But for the people out there that want, a little bit of a dividend yield and a little bit more stability, I get it. There's a lot of volatility here. But if you want something that's more steady Eddie, maybe you're closer to retirement, this is something to consider. And that kind of builds into number 26, which is FedEx. And this is a company that I feel like really isn't going anywhere. So maybe consider selling naked straddles, where basically you're selling calls on the top and selling puts on the bottom. And you're just hoping to collect the premiums because the stock is probably not going to move above those ranges right there. This is maybe a stock that you want to do that for. Number 27 is going to be AMAT, which is Applied Materials. The stock is up over 266% in the last 5 years. And really, if you just think this AI show is going to keep going on, this stock will probably do good. But if AI happens to do a pullback, I think you're probably going to get smoked on this company. So definitely be very, very careful. ASML is a big one. And we got to talk about this here because ASML is the company that basically builds the machines that builds the chips. So ASML sells a lot of these machines to companies like TSM that actually manufactures the chips. You can see the stock's up 171% in the last 5 years. You can't have AI without ASML. But the thing about ASML is, companies like TSM, they already bought a lot of the equipment that they need. So ASML did just report earnings and they guided kind of crappy going forward. So we'll see how that actually pans out. And it's trading at roughly 42 times trailing earnings, which is a little bit on the expensive side for the little bit amount of growth that they're giving us right now. So if you have shares, consider selling covered calls. Berkshire Hathaway, we all know what Berkshire Hathaway does. It's Warren Buffett's company that basically is just up and to the right. There's going to be a lot of volatility again, but this is a company that in itself is basically like an ETF. You know, they own insurance companies like Geico, they own a lot of Coke, they own a lot of Apple, they own a lot of, various other little companies that comprise this company. And then they take the profits from those companies all to the bottom line. So Berkshire Hathaway is something that you could hold for the long term. Coming in at number 30, we're getting close to the end, and remember the five at the end are the straight bangers. Now, Disney stock is a way to gauge how the actual economy is doing because if people don't have money, the last thing they're going to do is go to Disney World and spend 20 bucks for a drink. So, the stock is down 14% in the last 5 years. This is something to consider doing some sort of naked straddle on if you want to sell calls and sell puts and you hope it falls in that volatility range. You'll collect some cash flow doing that. Home Depot is a company that is up and to the right, but I do think that Home Depot is expensive. So I'm in the camp of, again, if you have shares, maybe sell the shares, maybe sell some calls, or maybe buy some puts. I do think that Home Depot is going to be, expensive for the long term here. But again, the other tailwind and risk against that is if interest rates fall and people start buying homes, be careful with this one because people are going to go improve those homes once they buy it. They're going to go buy a can of paint or go buy a light bulb or whatever they're going to do in their house. That could be a tailwind for Home Depot, so be careful on that. Robinhood, geez, this stock has been on an absolute freaking tear right here. If I do it from the bottom right here, let's just see how big this move was. 1,600% roughly. They're definitely the innovators in the brokerage space, and I don't think that really anybody is innovating as good as they are. But again, this is still a pretty small company when you look at it compared to like Fidelity or Charles Schwab when you do it on like a ratio of how many assets are actually on the platform. But this is the hot stock and it's the hot platform that all the new expert traders in this bull market are on because everybody's an expert right now because I guess stocks only go up, which it's not always going to be like that. So you got to be very careful right now. Oracle, again, is a company that, geez, this stock has been on a tear too. And they're involved with Stargate, so they're getting a little bit of a tailwind behind them on that. 406% in the last 5 years, but I do think the stock is expensive, and I think there's headwinds with their AI data center build out because apparently they're losing money on that, so you got to be very careful. Starbucks is a company that I'm against, and I am not going to buy this company. I would consider selling calls on it or selling your shares because I just think the Starbucks is too expensive. There's a lot of competition, and I just don't think that they could raise their prices right now. Charles Schwab is a competition with Robinhood, and I really only put Charles Schwab on here because I have a couple $1 million in my brokerage account with them, up over 142% in the last 5 years, though. I do think that Charles Schwab and Robinhood will continue to do good going into the future, but Charles Schwab is trading at a much, much, much cheaper valuation level. Uber is a company that if you believe in Tesla, it's kind of hard to believe in Uber because robotaxis are coming. I have a Tesla, it's great. The stock's up over 170% in the last 5 years for Uber, by the way. And Uber doesn't really have a detailed plan of what they're going to do to compete with robotaxi. If it's cheaper, safer, and more efficient to have a robotaxi, people are going to do that, and people are going to go to Tesla. And who knows, maybe Uber will kind of be like the next BlackBerry, where it kind of goes out of business. Time will tell. Walmart is the next company that I am definitely not buying. I think it's expensive. I think that Amazon is crushing them, and I would sell your shares, sell calls, or buy puts. I'm pretty bearish on them. But getting into the bangers right here, starting on number 38, we have Meta. I think Meta is a company that's going to definitely keep exploding in growth, and they've been spending so much money on their AI data center build out that once that spending slows down, that capital expenditure, they're going to bring a lot of that money to the bottom line. And when that money comes to the bottom line as earnings per share, the stock price is probably going to go up. And of course, they're going to start to reap the rewards from the data center build out. Stock's up 173% in the last 5 years. And honestly, I think the show is going to keep going on with Meta. TSM, this is, a big dog right here because they control over 95% of the AI data center build out, roughly 90 to 95. Stock's up over 250% in the last 5 years. And really, like, if you believe in AI, which I do, you don't have to know if AMD or Nvidia or Marvell or whoever's going to win. You know that whatever they design, TSM is probably going to build those chips. So this company has a very durable competitive advantage here. Now, if we go to Amazon, I do think that Amazon is underappreciated right now. Their earnings per share growth has been great. They've been having a lot of CapEx spending. And once the CapEx slows down, the earnings per share will go up, kind of a similar thing as Meta. So I recently sold some puts on this. I'm recently, I'm going to buy some shares and maybe I'll buy some calls. We'll see what happens. But I am bullish on Amazon for the short, medium, and long term. That also applies to TSM. That also applies to Meta. Coming in at number 41, if you think that interest rates are going to go down for really any reason, you think the stock market's going to crash or the Fed's going to get fired and a new Fed's going to just drop rates, BLV is something to look at because it tracks the price of bonds and it's also kind of like a hedge too. So if the stock market happens to fall, interest rates will probably go down with it and bond prices go up. They move inverse of each other. So this share price will probably go up and you're probably going to capture a little bit of share price appreciation too. Now coming in at number 42, the big dog, United Health. Look at this drop right here, down over 62% on this dip from peak to trough, basically right at the beginning of this year. And I bought the dip down here. I bought some leaps. I bought some shares. I sold some puts, captured a pretty good bounce so far. But I do think that this stock is still cheap and I think it's still a buy under 400 bucks a share. So I'm going to be patient and I'm going to be holding this one for the long term. And it just so happens to be that Warren Buffett's Berkshire Hathaway bought some shares too. So that definitely helps us out a little bit. All right, so that was a super quick rapid fire of 42 companies that I feel like give you a little bit of a baseline of what's going on with them right now, how to make plays, what plays to make. If you got value from this, definitely like and subscribe. Watch this video right here. YouTube thinks that you're going to like it a lot, and I'll see you guys in the next one.